Trading range can be very tricky for majority of traders. It's very difficult for traders to distinguish between range and trend. Well, it's very understandable because they have some similarities which can mystify our eyes. Trend is essentially a breakout phase. Range is essentially a consolidation phase. Market is rotating between trend and range. It's like climbing a mountain. You climb to a point where you think it would be a good place to rest and refill your energy. You rest for a while, then you continue climbing if you have the strength. Otherwise you will quit and go downhill. Market works exactly the same way. For example, price trends up for a while, then goes to the consolidation phase, range, either to resume or reverse. At one point, there will be an initiative up or down move which breaks out of the consolidation parameter. If a breakout to the upside attracts more buyers, price will go up. The previous uptrend will continue, a successful breakout. If the equilibrium is not broken, the excessive bullish move outside of the consolidation parameter will be sold into. It will leave a long wick on top of the bar. Price will return back to the original range and continue swapping. The consolidation phase continues. If more people think the current price is not fair anymore, or the buyers are showing weakness, the sellers will take control, breaking out to the downside, a potential bear reversal. The relationship between trend and range is that they are interactive. One can't survive without the other. Your job is not predicting between trend or range. It would be a waste of time. Your focus should be how to get into the flow and trade accordingly. Be flexible and be prepared. If it's been trending up in the morning session, expect a consolidation at noon. Expect it, don't predict it. Prepare for it. Don't try to impress yourself by proving your predictions are right. Thinking in probability and act on what the chart is telling you. Characteristic of the range. First, the wicks. Trading range is filled with wicks, especially more on top and bottom of the approximate range parameter. The reason behind this is back-to-back failure. When price is being pushed up to the upper boundary of the range, sellers are letting it go. See how far price can go. The higher it goes, the more profit for sellers when they sell into it. It creates a vacuum effect. That's why as the price is approaching to the boundary line, it will speed up, bar becomes large in body. But don't be fooled. Sellers are not disappeared. They are waiting and watching the levels closely. When price becomes excessive, sellers will jump in and sell into buyers, pushing the price towards the lower boundary of the range. A perfect-looking bull bar turns into a shooting star when the bar closes. Entering at the extremes offers great risk-reward ratio for traders. Smart traders love range day because it's so predictable. They just scalp at the extremes back and forth. This leaves many long wicks around the edge of the range. Wicks are failures. Top wick means buyers failed and bottom wicks means sellers failed. Remember this, range will have multiple failed breakout attempts before the real breakout. When the real breakout occurs, you can't miss it because it's convincing both in volume and bar size. Any inferior breakout will fail within a short time, generally within 5 bars. The green and red arrows refer to the wicks of the failed breakout attempts of the range. Look at the wicks within the range. See the congestion area filled with dojis and bars are overlapping. See the bull-bear alternation, which shows lack of consistency for either side. The bar shows the real breakout of that range. The bar is forceful, large in size, closed very low and minimal wick.